Hello viewers, we'll be going over gold and silver futures. In this video, we'll be going over the day-by-day probability model, the technical performance of each model, how we find the models, and the day-by-day forecast for gold and silver. So back to the technical analysis. Today we're down 1% on gold futures. On the 1 hour chart, we're touching oversold RSI, and we approach to negative MACD. As for the 4 hour chart, we see a nice volume to the downside, and we are not near oversold RSI yet. If we expand that further to the daily chart, we start to see a divergence of the daily MACD, and one could say that the uptrend has been broken. Reason why, if we make higher lows, we saw the trend to break. If we do close down below, or if we do close down where we are now, the uptrend has been broken, so we may see sideways price action in the meantime. As for support, if we do manage to fall lower, I do see a possible support around the price of $1,680. Reason why, we had previous support that dated back to April 8th and as well as April 21st. And as for resistance, if we do manage to head up higher and make new higher lows, the next resistance will be around $1,760. And if we were to climb higher and hit resistance, that price movement is roughly around 4% to the upside, and to the downside to hit support, that is roughly around 81 basis points. So let's head to the day-by-day probability model for gold. For this, we'll be examining GLD, ETF ticker symbol for gold futures. So as the days progress to the 7th day, we have a 55% chance for gold to climb higher between 0 to 4%. On the extreme case, we have 11% for gold to climb between 4 to 8%. On the other hand, we have a 22% for gold to fall between 0 and negative 4%. On the extreme case, we have gold falling between negative 4% to negative 8%. And now let's examine the day-by-day forecast for gold futures. So we have 1 day out. So 1 day out will be a Friday, and two days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? First, we want to compare the two trends. And the blue line is the trend that we're currently in, and the trend that I found to be the best match dates back to November 10th, 2014 to February 6, 2015. So we have the current trend right here, and below is the trend that I believe is the best match. And again, this trend dates back to 2014 to 2015. So let's start comparing the two trends. So what we have here on the current trend, we start out at the middle Bollinger Band, proceeded to touch the upper Bollinger Band, reverse to touch the bottom Bollinger Band. Once more, we touch the upper Bollinger Band, and now we revert back to the mean to the middle Bollinger Band. So we have those points there. And now the trend in question, we start off at the middle Bollinger Band, then proceed to touch upper Bollinger Band, reverse to bottom Bollinger Band, and then climb higher to the upper Bollinger Band and revert back to the mean to the middle Bollinger Band. So what we have here is 1, 2, 3, 4, 5 points. We also have 1, 2, 3, 4, 5 points. So there's reason to believe if the trends and patterns are the same, the outcome and forecast should be fairly the same. So the model that we just examined was, I would say, November 10th, 2014 to February 6, 2015. Back then, gold fell around 2%. So if we head back to the day-by-day probability model, that coincides with the standard deviation of 22% between 0 and negative 4%. So let's examine the technical performance of each model. The trend that we're currently in, it is down 3% from monthly high, 13% from monthly low, down 1.5% from 10 simple moving average, down 62 basis points from 20 simple moving average, and up 2.8% from 50 simple moving average. And now the trend that we just examined, November 10th, 2014 to February 6, 2015, it was down 5% from monthly high, up 6% from monthly low, down 2.8% from 10 simple moving average, down 2.5% from 20 simple moving average, and up 71 basis points from 50 simple moving average. The two trends have technical similarities, and again, these models are now available in the link below, so do check it out. So let's examine silver. So we'll start off with technical analysis first. So silver is currently down 1.8% on the 1 hour chart. We are now at oversold RSI. We are slowly approaching to negative MACD on the 1 hour chart. As for the 4 hour chart, we saw a divergence in play. As indicated, we also see a large spike to the downside in the volume. For the daily chart, we were close to positive MACD, and now we start to see a divergence for the daily MACD, and we may now turn negative for the MACD. As for support, if we do manage to head down lower, the next possible support that I see is around the price of $14.35. Reason why, we saw previous support that dated back to March 31st around that range. However, if we do reverse and head up higher, the next resistance was made around the price of $16, and we touch the 50-day moving average, this yellow line. That will be our next resistance if we do climb higher. And to reach that resistance, that price movement is roughly around 6.7% to the upside, and to support that price movement is roughly around 4.7% to the downside to reach previous support levels. So now let's examine the day-by-day probability model for silver. We'll be using SLV. And as the days progress to the 7th day, we have a 40% chance for silver to climb between 0 to 8%. On the extreme case, we have 30% chance for silver to climb between 8 to 16%. And the extreme case, we have a 10% chance for silver to climb between 16 to 25%. So on the other hand, we have a 20% chance for silver to fall between 0 to negative 8%. Now let's examine the day-by-day forecast for silver. So we have 1 day out, 2 days out, 3 days out, 4 days out, 5 days out, 6 days out, and 7 days out. So which one of these models we should focus on? Ideally, the model that is best matched to the current trend. And May 9th, 2013 to August 5th, 2013 happens to be the best match to the current trend, what we see here on the blue line. And now the trend here, this is our current trend we're in, and the trend that dated back to 2013. So let's compare the two charts. So we start off at the bottom Bollinger Band, proceeded to dip lower to further down the bottom Bollinger Band, reverse to upper Bollinger Band, and then revert back to the mean to the middle Bollinger Band. So now the trend in question, we start off at the bottom Bollinger Band, dip lower to the bottom Bollinger Band once more, and reverse to the upper Bollinger Band, and revert back to the mean to the middle Bollinger Band. So what we have here is 1, 2, 3, 4 points. We also have 1, 2, 3, 4 points. So there's reason to believe that the trends and patterns are the same. The outcome and forecast should be fairly the same. So the model that we just examined was May 9th to August 5th, 2013. Back then, silver was up around 10.3%. So if we examine the day-by-day probability model, that coincides with this standard deviation of 30% for silver to climb between 8 to 16%. So let's just examine the technical performance of each model. So the current trend that we're in. So let's see. Current trend we're in, we're down 26% from monthly high, up 18% from monthly low, down 2.4% from 10 simple moving average, down 2.4 simple from 20 simple moving average, and down 4% from 50 simple moving average. And now the trend that we just examined, it was May 9th to August 5th, 2013. Back then, it was down 21% from monthly high, up 6% from monthly low. It was down 1% from 10 simple moving average, down 70 basis points from 20 simple moving average, and down 4% from 50 simple moving average. There are technical similarities among the two trends. One key difference is the monthly low. the current trend that we're in is fairly up, quite high, up 18% from monthly low. Compare that to the trend that we just examined, it was only up around 6%. So do keep that in mind. Again, these models are now available in the link below, so do check it out. If you enjoy this content, feel free to like, comment, subscribe, and thank you for watching.